Welcome, everybody. We are very excited about having everybody here today. We are waiting a moment to make sure we get let people get in, but looking forward to a good crowd here today, and appreciate everybody coming. We're using a new format, so we're actually using Microsoft Teams, which is a little more secure than Zoom. So that's part of our contribution to bringing the new format to everybody today. Hey, Dan. I think I'm going to get started. The first of all, wanted to welcome everybody to our first ever financial chalk talk, especially talking about COVID topics as during the crash, or crash course during the crash is what we're calling this. Big day today. Showered and shaved. Well, I think Coach Wooden would be proud of me. We feel strongly that. As Nelson Mandela said, sport has the power to change the world, and that if we can communicate and empower coaches to have some more knowledge in the financial and investment space, that knowledge can be communicated to many others as coaches do. Today's intent is to be of service to the coaching and the sport community. We aren't going to talk about CoPeace. If you want to learn more about CoPeace, go ahead to CoPeace.com to learn about what we're trying to do here. But today we wanted to create something that was special for the coaches and give people access to knowledge that hasn't typically been shared, especially with communities that typically didn't have access to the financial knowledge. So we're going to make it very interactive. We're opening it up for questions and answers later. There's a Q&A button. As you hover over your screen, you can start adding questions, and Meg will be moderating those toward the end. So looking forward to question and answer period. A lot of people know some of us from the coaching realm. Lee Klein, who has been our director of sports strategy, has also been kind of helping us organize this, and we're very excited about having him part of it. Lee is best known by most of you from his time in the Dream Chasers television show that was on Fox for a long time. He's also known for his days at 5 Star and being an integral part of the coaching community. We're very happy to have him as part of our team. A lot of you know me as well. I was a former head small college coach, former Division I assistant. Worked with started Coach's Edge and worked with Sport Vision. Worked with Basketball Travelers to kind of finalize the Nelson Mandela story. I was actually the first American to give basketball clinics in South Africa post-apartheid. Al McGuire sent me there, and it was a life-changing experience for me, and one that affected some of the things we're trying to do right now. One of the important things that I wanted to point out, and kind of are appropriate here in the coaching realm, is that for us, it's all about the team. We have a very strong team, a team that helped put this together in pretty short notice. I think the NABC put out the announcement on Monday, and we rallied and got this put together. So Meg and Ed and Jacob and Jim is producing it right now, and Hanan and Dan and everybody else. We're very lucky to have a strong team. Next, Jim. So today, our goals for today's talk are, we're just trying to provide a basic financial concept. Trying to put together some concepts that will be hopefully easy for everybody to understand, but we know everybody's coming at it from a different perspective, so please ask a lot of questions. I'm assuming a lot of people saw the Last Dance last weekend. My youngest son was didn't know much about Michael Jordan and was very interested in watching it, although he was complaining about the commercials and the fact that he couldn't watch the next show right away like he does on Netflix. But I know I felt bad for Scottie Pippen's agent. One of the things we want to talk about here is, making good decisions and having some knowledge. And it felt like, Scottie hadn't been as well advised as some of the other people. His historic contract that he gained in the NBA was actually more than Jordan's, but all the other peripheral things and some of the ways he was advised were obviously quite different. We're going to talk a little bit about the landscape. It's crazy times, obviously very difficult for a lot of schools. A lot of articles about schools cutting back. I know people are in between jobs and things like that. So want to talk about that a little bit. My oldest son actually spent a night in the emergency room. He former college basketball player, former 5-star basketball alum with the COVID, and it's scary stuff. So we know how that's affecting the community. So we want to make sure we attend to that today. This is not Station 13. If you know the 5-star world, that Station 13 is kind of the tough drill at the end of a lot of other things that go on. So today's intent is to be much more painless and trying to be something that is we're contributing. We want to, as we talked about earlier, we want to be of service to the community. So the idea here is to provide something that you may not have had access to, and we think that that's a good project for today's time. Talking about the interactivity, so add your questions hitting that Q&A button. That'll go to Meg, and then Meg can help moderate that. So I'm very pleased to introduce today's experts. We're fortunate to have Hanan Levin and Dan Hattori on the line. Hanan is our CFO, and he's also the Director of Capital Markets with Bank of the West, based in Denver. He's an experienced finance professional equipped with in-depth knowledge on the global networks and markets with an eye toward impact and sustainability. He's proactive, innovative, and competitive, and he's always looking at new ideas. He has a bachelor's of economics from Yale and an MBA from University of North Carolina. And Hanan has also a sport background, as he was on the Israeli national swimming team, as well as the Yale University varsity swimming team. So I'll be turning it over to him soon. We also have Dan Hattori. He's the CoPeace Senior Investment Advisor based in Chicago. Dan also has deep and diverse background in investment and as an entrepreneur. He was one of the founding members of Deerfield Capital Management's bank loan team that helped grow assets under management from inception to over $9 billion. He's also been portfolio manager responsible for over $1.5 billion in bank loan assets. He's served as financial analyst, and he's worked as an internal auditor and has a wealth of experience. So we're very excited about having Hanan and Dan in the house. We'll be interacting a little bit as they go, and then look forward to a question and answer at the end. Take it over, Dan. Take it over, Hanan.
Thanks, Craig. Thanks everybody for taking the time. Like Craig said, the goal of today is really to give a very high-level overview and a little bit of insight into the noise that's happening right now in the markets. I think there's a lot of voices out there, a lot of uncertainty for sure in every aspect of our lives, but especially in the financial market because it's so intertwined with what we do every day. So what we want to do is go over just very high level understanding of what's going on, so you guys can get a little bit more comfortable with understanding where we're going, what is happening, and how can you react in a general level. If you wanted more information or more advice, we can go deeper into that in other aspects or in different times, but this is really meant to just give you kind of a starting block of understanding of what's going on and how that's impacting the financial markets, how that's going to impact your personal portfolio, your personal finances, and everything in between. So investing before COVID might sound simplistic, but it was pretty easy. We've had a historic bull market for the past several years. We can easily look at the endowment sizes here. We see the nice graph after 2008 crash of it's just going up. And that has been relegated not only to the stock market and bond market that we all follow, but also the real estate market in a lot of places, where basically everything you invested in slowly moved up. It has its ups and downs regular to the market, but not really any major disruptions in it. So it was kind of a no-lose situation. You just put your money in the S&P 500, you put your money in a general mutual fund, and as long as you stayed pretty conservative and kind of in line with the market, the money went up, and that's great and that's wonderful. The problem with that market is it's a lot of times that market lulls a lot of investors and investment advisors into being a little bit complacent. We all know when things go well and they go well for too much time, people don't like to make changes. They don't like to change their strategy and re-look at their strategy. But as you guys know, and I don't need to tell you, every season and every year you have to come up with some tweaks and turns and look into what the strategy that you're going to go look into going into the season. And that's really what we're trying to help you do here is what is the best strategy of going next into the next season. And we know the next season is going to hurt, and we know the next season is going to be painful. We all see on this graph, for example, the major drop that we had from the endowment value in 2007 when the market was at its peak before down to 2009. Unfortunately, what happened with COVID is that we've had this reaction happen instead of over several months or even a year. It happened pretty much within a month. And that has been what has really scared the market, really created a lot of impact and a lot of uncertainty. I think it's difficult because of the complexity of the issue, which is a disease that we don't have solutions for it yet, to know when it's going to end. And I think that is creating a lot of uncertainty, a lot of, in every aspect, starting from when am I going to get out of this house? You guys can't see it, but I'm in my second office that's not set up, and I have a lot of trash behind me because this is our storage room, because my wife is in the different office doing video calls and my daughter's doing online calls. And, you know, I don't think anybody wants to continue to have that, but we don't have a time frame of when that's going to get better. Similarly, we don't have a time to know when can we go back to restaurants. We don't have a time frame to know when our business is going to start ramping up again and we go back to our normal. On top of that, we don't even know what our new normal is going to look like. What all that does is create a lot of uncertainty, and it moves, and we have to adjust our strategy because of that uncertainty. In the past, you know, if you looked at your portfolio, you wanted to break it down. If you look on the left at the pyramid, there's the liquid investments that you need in general to cover your aspects. Then you have a little less liquid assets, the CDs, stocks, and bonds. Then on top of that, you have alternative investments, which are not liquid for about 5 to 10 years usually. And then on top of it, you have philanthropy, which is obviously just creating a brand, helping the causes that you guys support, and helping the communities that is supporting you guys, which is great. That picture obviously has changed from I'm just going to continue to plow money in a proportionate level into these buckets to creating a new strategy to a new level. And Dan will go into a little bit more detail about that. But I just wanted to show you the general perspective of how one would have built a portfolio, how one would have allocated the money. And as you see, liquid investments obviously is a bigger tranche of money because that's the money that you'll be paying for rent. That's the money you'll be paying for your mortgage, car payments, daily groceries. So you need to have that liquid. That's your savings account, checking account, whatever. CDs, stocks, and bonds is stuff that you don't want to get into day in, day out. It might be for like larger transactions like buying a house, like college for your kids, what have you. And then illiquid investments is more of super long-term retirement money and what have you. And obviously philanthropy is money that you're not going to get back. So it really needs to serve the purpose and be understood how that is allocated within your budget. So Jim, can we go to the next slide? So now that we have market implications, how is the market going to look at future? So one thing we know of is the economy is gonna be suffering, and I want to backtrack a little bit. I'm gonna sound very doom and gloom, unfortunately. I'm gonna try and not do as much as I can, but I'm really trying to give you guys a perspective and the true, honest picture of where the market is, where I see the market going. And I promise I'll try to end on a positive note. But really, what we're trying to do here is to give a good picture of where the market is going and how you better prepare. And I think similarly to what I would want from our administration is I'd rather know that I'm staying at home for another 2 months than somebody telling me that I'll be back to work tomorrow, and then tomorrow tell me no, it's going to be the next day and the next day and the next day. Setting up expectation and setting up the worst case scenario. And then if it gets better, that's awesome. I'll be much happier with that than shattering my expectations every day and saying tomorrow's going to be all going to be better and we're all going to go back to normal. So I think I just wanted to frame kind of the point of view that we're coming from to this conversation. So as you guys see,
Hanan,
go ahead.
It's, people are coming in this at such different places. I mean, you and I have the ability to have our kids on another device, taking school, using the internet, being able to wash their hands. And, we're finding so many communities that don't have running water and things like that, where the COVID affects that even more. So I think listening to your perspective is important depending on where you're coming in from the spectrum.
Definitely. And yeah. Yes, obviously this is for investment perspective, the ripple effects of the economy that this is going to impact are extremely disproportionate to the lower income, the mom and pop shops, the kind of the not 1% of the economy is going to be suffering disproportionately to the 1%, if you are the top line of the economy, because as we see, it's the mom and pop restaurants that are having a hard time. It's the small businesses that are having a hard time to continue and operating. So it is definitely, I agree with you, Craig, it is impacting them negatively. If you look at the kind of the easy to see here, this is the net returns of university endowments, and you can see obviously the huge drop that we had in 2009 in those returns. Obviously, we don't have the data for this year, but I'm expecting similarly to that or worse of a drop in those returns. What that means is budget cuts in every aspect of university spending. Obviously, that will go into the athletics aspect as well. And if you look on the other graph, that's the state spending on higher education. Before the recession, they were at all-time high. You see them going down, but even when they started recovering in 2013, then they have not recovered into times before that. So all that being said is university, public and private, are going to be in the same boat that a lot of other businesses are. When you think about that, the lack of revenue from fees, housing, food, athletic events, right? Spectators, all the canceled events are going to have impacts on budgets and returns and future allocations and how we look at it. So that's on the private and public markets from the university side. On top of that, we have the volatility in the public markets and the interest rates. The market did drop about 30%, but then went up again 18%. In my opinion, it wasn't really a reaction that was proportionate to the problems that we're seeing. It was more of a market reaction of people thinking they hit the bottom and trying to get back into the game and trying to get returns. So what I expect, is not to, again, be doom and gloom. A lot of continuous volatility. As news come out, in and out, we're going to see extreme volatility in the stock market, going up and down all over the place, because nobody really knows. And I think as the sooner we all realize that nobody knows more than you and I, the better we all will be. All these investment experts out there, if you CNBC or watch it or your advisors, they don't know any better, because the issue that we have is not a financial issue. It's not an economical issue that we can go back in the past and model it and say, okay, the recovery took so long. The issue is, like I said, is COVID, is the fact that we can't restart our economy. And until we are able to know what the path is, what the way we do it, we're not going to be able to see the roadmap. So we're going to see a lot of volatility because there's going to be a lot of, oh, is it done now? Let me go back into the market. It's not done now. Let me get out of the market. As far as interest rate goes, that's probably one silver lining. If you're in buying a house, refinancing, rates are going to stay low for the end of the year. That's my expectation. The Fed is lower. The Fed fund rates to zero. Money is going to be available in a cheap area, meaning interest rates will stay low. The Fed will continue to keep the rates low in order to invigorate the economy and try to support them that way. That being said, again, I'm going to go back a little bit to the doom and gloom. The banks are going to be hurting, which means the banks are going to be less interested in taking on riskier loans. So that's kind of the back and forth that we're seeing. And I know a lot of people are hearing it, that rates are low. So I just wanted to give the other side of it is the rates might be low when you go to your bank to refinance or to get a loan to maybe your small business or get any other loan. And it might not be as easy to get those loans directly from the bank because the risk appetite of the bank, because of the economy and its view has gone down because there's a lot more unknown, like I said before, and they're not as willing to take those risks. So I think
Hanan, so if some coaches may have lost their job or be in transition, things like that, the same thing applies to a personal loan, for example. I think some people have been advised, hey, you can go get a personal loan because the rates are so low. It's probably not as easy as it sounds like it would be.
Yeah, definitely. It's not. I just saw an article that JP Morgan kind of in general is going to limit their mortgages to a credit rating above 700 and will require 20% down payment. Now, I advise everybody to take these articles with a huge grain of salt because those are, like every other article, are clickbait. If you go to JP Morgan Chase today and have been a client or a good client, and you can work with your personal banker to not do that. But I think that article and that kind of news just shows us the general concept and general idea of the lack of risk that the banks are taking a step forward, both on the like you said, Craig, on the personal loan and the mortgage loan. They're not going to be impossible. They're going to be harder, and they're probably not going to be those extreme low rates that everybody's advertising out there. Go ahead to the next slide. I think the next slide is Dan talking a little bit more about the portfolio. So I'll pass it over to Dan. He'll be talking a little bit more about the portfolio management and that aspect of that. And then I'll come back on to talk a little bit more about different aspects of it.
Well, thank you. Thank you, Hanan, and thanks for everybody for attending this presentation. As Hanan mentioned, I'll be talking about portfolio and portfolio management. Your portfolio is not just your investment portfolio, right? It's not just your stocks and bonds. It includes, your bank accounts. If you have a 401k account, if you have equity in your home, that's what entails what your portfolio entails of. And it's really important. And I think during this particular time, it shows that it's very important to have a strategy and to manage this portfolio, because you want to do two basic things. The first is you want to protect your assets. You don't want to take losses. And the second factor is you want to maximize your risk-adjusted return. Now, these two concepts are there's a lot of tension between these two concepts because if you don't want to take risk, that's where you get protection of your assets. However, you need to take risk in order to generate a maximum amount of a return for your investments. And this tension is really what portfolio management is all about. It's about the balancing of the need to protect your assets versus your want to generate and maximize your returns. So as you begin to think about your portfolio and the construction of your portfolio, there's a couple of things you need to think about. The first is, what is your investment objective? And you can have multiple investment objectives. You know, the first one could be, and I think everybody has this, is you want to retire at some point. And so based on your age, there's a time frame for which you will start needing that money. Or if you have kids and you want to start saving for their college funds, once again, that's the objective. There's a time frame. If your child's just born, you have an 18 to 22 year time frame. As your kids get older, that time frame starts to shrink. The impact of how you manage your portfolio is correlated to the amount of time that you will need to when you want to start to access that money. The other factor you want to consider when you're constructing your portfolio is the amount of risk tolerance you have. You know, a person who sees the stock market changing, let's not be as dramatic as what we've just seen with COVID, but you know, a normal, you know, small drop in the market, and they see a loss, and they can't sleep because of that. That might be an indication that you're a little bit more risk averse versus a person who, you know, who doesn't mind handling those losses and is a little bit more aggressive with their investments and their thought process. They'll probably have a great more deal of risk tolerance there, and your risk tolerance will affect the portions of how you allocate your assets between cash, fixed income, or stocks. You know, diversification is another concept that's very important within the construction of your portfolio, and this is something that you know, everybody on this presentation lives every day. In terms of basketball world, especially college basketball, you can relate it to recruiting. Let's say you have a senior point guard who graduated this year, and you have a need for a point guard for next year. There's one player who might be the top of your list, who might be a good get and might be able to change a program, and you want to devote, you know, limited resources, which is time, recruiting time, or recruiting budget to recruit that one particular player. The question is, are you going to spend 100% of your time just recruiting that one player, or have you identified a list of 5, 6, or 7 players, and you might allocate 50% of your recruiting time to this first player because they're such a dynamic player, and then proportionally less for each additional player. And what you're really doing there is you're diversifying your risk. If the number one player decides not to go to your school, you spent the time, you have a relationship with these other players, and the ability to recruit them and have someone come to your school is much greater. Same exact thing is true for investments. You want to diversify not only within an asset class, meaning that you don't just want to have stocks in your portfolio. You want to have some fixed income. You want to have some cash available. You may want to invest in more riskier alternative assets, and that's good, right? And in addition to that, you know,
Dan, to go back
yeah.
to the Bulls analogy. I love the way you explained diversification, but the asset allocation is kind of like adding Dennis Rodman to get rebounds and getting Steve Kerr to shoot the threes, and I like taking that to another level where you have to have everybody's got to have a role, and I think the same thing can be said in what you're talking about here.
I absolutely agree with that, Craig. You know, within your allocation of assets, just like when you're forming a team, they have different roles within your portfolio. an equity investment will be greater risk, and what you're trying to do is generate more returns. However, you have bonds in your portfolio to kind of help mitigate some of the risk that you would see in the equity markets. You won't get as many returns, but your risk of loss is significantly less. So they play different roles within the portfolio, just like the basketball team. So once you understand that you have an investment objective, you understand what your risk tolerance is, now you want to start actually allocating your funds. And you can spend multiple presentations on how to best allocate your funds to your portfolios. So we'll just keep this at a really high level, and what I'll focus on is more on a retirement account, because that's something that the first thing you want to do is make sure you have enough of cash available to handle the day-to-day, month-to-month needs. And after that, then you can start investing the additional funds into, part of it could go into a retirement portfolio, some of it could go into a college fund, or whatever other needs you may have. But for your retirement fund, there's a specific general rule that people use, and they call it the 110 rule. And what this means is that based on your age, you take 110, subtract out your age, and that's the percentage of your retirement portfolio that should be in equities. So let's take, for example, let's say you're 35 years old, 110 minus 35, that means that's 75%. So 75% of your retirement funds should be allocated to equities, and then 25% should be allocated to fixed income. And that's just a general rule of thumb. And then you layer upon that what your risk tolerance is. If you have a lower risk tolerance, maybe you don't want 75% of your portfolio in the stock market. Maybe it's 65%, and instead of 25% fixed income, maybe it's 35%. And the inverse is true if you have more risk tolerance. Instead of 75%, it's 85%. Or maybe the types of assets that you're willing to look at if you have a higher risk tolerance might be more one-off investments that have a much greater chance of return, but also have a significant greater chance of a downside as well. So asset allocation is accumulation of understanding what your investment objective is, what your time frame is, what your risk tolerance is, and and that's kind of in general how you would go about creating a portfolio. I was asked to talk about the COVID impact on kind of portfolios. I think Hanan went over it very well. The truest answer is no one knows, right? We're in an unprecedented period of time. We never purposely shut down the economy. So how do we recover? We don't know. It's going to take time, and there's going to have to be answers to the unknowns. But what I think is, if you looked at all the market turbulences that we have seen in the past, whether it's the financial crisis in 2008, 9/11 attacks, dot-com bust, from a long-term perspective, and I'm not talking about 6 months or a year, it's 5 years, 10 years, 15 years, 20 years, what you should generally see is that there's a recovery and markets will return to some new normal. So while Hanan, in the short term, I totally agree with him. There's a lot of pessimism just because there's that unknown. Over the long term, this country and this world has seen lots of turbulence, and what history has shown is that markets do recover. So if you have a long-term strategy, my best advice is don't be emotional. Understand the market goes up and down, and trying to just stay with the strategy that you've had. You might want to tweak it a little bit. There's going to be certain segments of the economy, leisure, entertainment, travel, that they may never recover, or trends that have started that has been accelerated, like the stay-at-home economy. It's just been accelerated by everything we've been doing, and maybe that's here more to stay. And you may want to adjust certain aspects of how you invest, but whether you invest more in the stock market or less, I think long term, it's probably best to stay the course.
That's great. Dan, do you mind? I know for some people, just kind of a basic overview of a stock versus a bond might be just an interesting to discuss. Just kind of a high level, like, hey, what is a bond and what is a stock, and what does that mean?
Sure. So bonds come in a number of different forms. You have treasuries, which is the federal government-backed bond, and because of that, their interest rate that they give is because the risk is for the federal government-backed treasury bill. Then you have municipal bonds, which are issued by states and local governments. They have a slightly bit more risk because municipalities have defaulted. Detroit's one example. Puerto Rico is another example. So the return that you will get on a municipal bond will be higher. The interest rate will be higher than what you would see on a treasury bill because of the risk. The third one are corporate bonds, and these are bonds that are issued by companies, and relative to municipalities or relative to the federal government, there is more risk, so you'll see a higher interest rate associated with a corporate bond than you will with the other two. So that's kind of bonds in general. On the other side, you have equity, and equity is actually a share of stock within a public company if you're buying it on an S&P 500, things like that. And what equity is an ownership share of a company. And the way to think about it is a company has a capital structure, just like all of us have a capital structure, where if they take out bank debt, the bank debt is the most secure piece, and they have to repay that before they can repay, if they have bonds, before they can repay bonds, and any money left over after repaying their debt and their bonds will flow through equity. And the return that you get off of share of stock that you buy, so let's say in the S&P 500, it comes in two forms. One, a company could pay dividend. So this would be cash available regularly, normally 3 or 4 times a year, which would be equivalent to paying interest. And this would be excess cash flow that the company has generated that they want to give back to their shareholder. The other form of how you generate a return in a stock is the appreciation of that stock price. And the appreciation of the stock price is primarily due to the growth of the company. The better the company does, the more sales they do, the more profit they generate, the more value that's associated with that company. So that will increase a stock price. The other factor that could increase stock price is if what they call the multiple of a particular company. So the stock, and what a multiple is really the stock price relative to net income. If as people become more bullish in the markets, sometimes stock prices will rise greater than the profitability of that company, and therefore the multiple increases in that scenario, and the shareholder benefits from that. So,
yeah, perfect. Thank you.
Sure.
Appreciate that. Back to you, Hanan.
All right. And before I go into the impact investing versus philanthropy, I wanted to piggyback a little bit what Dan said. There are significant opportunities in the market right now. If we look at historic markets, what happened in 2008 or even before that, every time there is a recession, the immediate way to recovery is through infrastructure, is through businesses, is through the government supporting them, all the way from the New Deal to Build America bonds, which basically were government backed loans for municipalities to create infrastructure projects, because that's the easiest way to bring people back into employment and biggest way to rejuvenate the economy. That's just one example of many of opportunities that this would be a great way to find those opportunities and invest in them and put your money in those aspects, and then take advantage of that. So I think there are definitely opportunities as we see the market recovers. As Dan said, the market will recover. We will get through this. We've gone through many of things, catastrophes, natural disasters, terrorist attacks, and we came out on the other side stronger and better. And there's definitely opportunities in the market to take advantage, and not to take advantage, but to help rejuvenate the economy and support the rejuvenation of the economy, and to get a good return on the other side of it. So just wanted to definitely support what Dan was saying from that perspective, that it's not all doom and gloom, that even with the uncertainty, we do know that we're going to get better. The best way to look at it is, what are the mechanisms that are going to help us to get better, and how can I support those mechanisms to get better, and how can then those mechanisms support my growth, my financial growth, my financial stability for the future, to make it a two-way street. And that actually leads me to my next conversation here, which is impact investing versus philanthropy. In this times of crisis, we have a lot of things that are hurting, and as public figures that are out there, especially in your community, and being so involved in the community, I'm sure you guys are getting phone calls, emails, continuous reach out on donations, right? This cause needs money, this cause needs money, and all those causes are wonderful and great. And I think there is definitely a time and a place, and definitely some allocation for those of us that can, to allocate to some philanthropy. Unfortunately, what happens is, as we all see, the down in the economy affects everybody on this call. And that means that there's less money available for philanthropic endeavors. Besides obviously the support of the philanthropy and the feel good that it gives both you and your community, it is also a way to create an advantageous tax presence from gains. However, since there's not going to be a lot of gains probably in the market, that tax advantage goes away. So really in CoPeace, and myself, we're thinking about bringing impact investing, not necessarily as a 100% alternative, but as another way to look at supporting your community, supporting the different goals that you have, different aspects that you want to support, but in a way that will also provide you financial return. That's where impact investing comes in. Impact investing is basically investing in companies and organizations that are doing good for the world, but are also providing positive returns for your investment. So if you guys are passionate about a certain area, in addition to the philanthropy contribution that will probably be smaller because of just the financial aspect, you can use some of your investment money, some of the illiquid investment money or liquid investment money, depending on the type of impact investing company that you choose to invest in. By investing that money into that company supports the community, supports the world, and supports the way we do business. And then you're also going to be able to get a return from that company, just like any other investment. Hopefully that company grows and becomes successful. And it's kind of a win-win situation where you use your money, especially in this time where money is tight, into pushing it into a good cause that helps the environment, whether it be help socially, whatever cause you want to do, but kind of change the thinking that philanthropy is the only way that you can build your brand, that you can support the community that you're involved in, and support the causes that you want to support. There's a lot of various tools ranging from stocks, bonds, and illiquid investments that are incorporated in impact investing that you can incorporate in your portfolio, and that way you're, again, especially in this time where the portfolio is shrinking, are able to take advantage of that aspect of the market or that sector of the market. And as you can see, impact investing is really the intersection of all three of those areas of market. You can find investments that are liquid in the stock market and in the bond market. You can find illiquid and alternative investment impact investing. And obviously impact investing is part of philanthropy because it does good for the world and supports the world and the communities that you live in. So I just wanted to really bring that into the forefront. Did you have something to comment about that?
I thought that was outstanding. I think I wanted to I'm trying to put myself in a coach's perspective. I know we did some focus groups with people, and the kind of financial knowledge was something that was deemed as a foreign language for a lot of people. So if I'm a coach, I think the impact investing has a lot of potential to provide something for your community and give you a good return. So I think it's something obviously we believe strongly in at CoPeace. For Dan and Hanan, before we go into some of the questions, if I'm a coach that gets furloughed or laid off, and my 401k is down, and I'm kind of in between jobs or looking for jobs, what do you recommend for me as a coach? I mean, do I dip into my 401k? How do I do that? Or what's my strategy?
Well, there's new rules actually that, so we also had a question about it. So I wanted to answer that question while we had it. That our school matching is paused. It was 30 cents down recent valuation. So there's different aspects of what you can do. So if it is possible and you are in the financial ability to not do it, the best thing to do is nothing. I know that sounds counterintuitive, but the best thing to do right now, if you look at 2008, we have a perfect example. If the people that sold, if you're in a mutual fund right now in your 401k, it's usually the 401k programs are very plain vanilla mutual funds. There'll be S&P 500, there'll be ETF. The best thing to do is do nothing, because what we've seen from the historical, Dan talked about that a little bit before, is that the market will recover with time if you have the time. Now, let's assume that you don't have the time. There's new regulation that came out that allows you to take, in the past, you were able to take a loan out of your 401k. So what I would recommend is not selling. If you are able to not sell and dip into the 401k, that's the number one advice that you have. You don't want to sell stocks right now. What you want to do is to reach alternative aspects of it. One of the alternatives, a lot of the 401k plans have a loan that you can take out of the 401k. Kind of, you're basically the bank for yourself. The collateral is your stocks that are in the 401k, and you can take a loan. The loan in the past has been up to 50% or $50,000, whichever is the lowest of the two. They have the new regulation came out and they increased that amount up to $100,000. There's also a lot of new aspects that they came in that you can actually take a distribution out of your 401k and IRA without paying the penalty, and you have 3 years to pay it back. I don't want to go into too much of those details, but there's a lot of new regulations that coming in to support 401k and IRA withdrawals. I would recommend, looking into the tax ramification of that and look into those plans. And we can, set up a time and help as well. But I think the quick answer to the question is, if you can do nothing, if you can't do nothing, there are options out there, and those options have expanded extremely as a result of this crisis. So there are options out there, and like I said, up to $100,000 is the last thing I've read. But things are changing and evolving continuously, and the new regulations that are coming out every day are making it easier and more advantageous to use these 401ks to supplement the financial gap that might happen to coaches. That being said, I would not change strategies by selling something right now and buying something else in a large scope. I might make small adjustments, but all in all, doing nothing, as crazy as it sounds, and your 401k, if you have time and the ability, doing nothing is the best thing to do. And Dan, I don't know if you have anything to add to that, but.
No, Hanan, I totally agree with you. I think you answered that question exactly the same way I would. Taking money out of the market right now, you've already absorbed the bulk of the loss that you're going to take. So there's probably more upside than downside. So if any way possible to not take money out of the market is probably the best thing to do right now.
Since we're on the discussion of 401k, I just want to ask a follow-up question that came in. Thoughts on strategy for your current 401k, 75% conservative versus 25% aggressive on all new money coming in during COVID. Just kind of want to get your thoughts on that.
As Dan said, I think that has a lot to do with where you are in your life cycle. If you're in your 40s, I would even go more aggressive than conservative, because right now, as the market recovers, you can take that time, like Dan said. It's going to take about 3, 4, 5 years for the market to recover, but we know it's going to recover. That's the one thing we do know, because it's recovered in the past. So what we do is, if you're able to take advantage of a more aggressive strategy, now's the time to maybe be a little bit more aggressive. However, if you're later in your aspect, I wouldn't get more aggressive, because we are not sure how long the recovery is going to take. So I wouldn't change. Really, the change in the allocation of the aggressive versus not aggressive has less to do with where the market is, and that is true in any time in the market in the 401k. It has more to do in where you are in your stage of financial and life stages than where the market is. That's how I would approach that. And I see another question about taking a loan from the 401k is similar to the bank loan discussion. No, you're able to take when you take a loan out of your 401k, that is a feature that is built into your 401k plan. So you'll have to ask your 401k provider if that plan has a loan. Most of them do. If it is there, you can take it. This is your money you're taking a loan against. Basically, if you have, let's say, $150,000 in your 401k, you can take a $100,000 loan, and the rates are going to be pretty low, because those are pretty competitive rates. So you're able to take that. You're your own bank. So no, you don't have to get approval. It doesn't matter what your credit score is. It doesn't matter if you're employed or unemployed. You're employed because you have your 401k, but it doesn't matter how much money you make within that salary. It doesn't matter if you were furloughed or not furloughed. That 401k loan is your money that you're taking against. The negative aspect of taking the 401k loan is the fact that the money that you took out of it is not going to grow in the investments that 401k is in. So you can't double count, right? So let's say you had $150,000 and $150,000 was invested in a fund, and you took a $100,000 loan. Now only $50,000 of that will be invested because you took the loan out. So you're not double dipping as far as the growth of your assets versus the loan of the assets. What you took out in a loan is not growing in the same aspect.
That's great. Yeah, I'm going to pass it over to Meg. I know there are a lot of good questions in there. As coaches or people in the sport community, I've been in between jobs before too. After I was coaching, I had to kind of put some things together, and I think coaches have more of a skill set than people even realize, or that you may realize as a coach or as a person in the sport world. So there are quite a few side hustles that might be able to fill in the gaps. We'd be more than willing to provide some resources there. I think one of the things we'll do is send a kind of a follow-up information on some of the things we talked about here with some links, but feel free to contact us anytime with any questions, because as we talked about in the beginning, we want to be a resource for the coaching community. We know that as we try to make the world a better place, that sport has a significant role in that, and kind of an opportunity to make some of these changes. Meg Maston is our glue, and she's got a lot of sport connections as well. Both of her son and her daughter are Division I athletes. They may be our first, as we're signing likeness deals, we're already negotiating with both of them to be our first athletes. But Meg, I'll pass it over to you for some of the questions, and feel free to continue to ask you can just click something in the click the Q&A, and Meg will moderate some of these questions right now to Hanan and Dan.
Sounds great. Thanks, everybody. Keep the questions coming. I believe if you go bottom right corner, you can see the Q&As, and they'll come in, and we'll just continue publishing them. We've answered several already. Before we pivot away from the 401k discussion to some other questions, there's one more related to this topic. Is there a specific area of typical 401ks to look to have the money sit tight until the market starts to rev up again, not looking to borrow or take out?
I'd say the general market, Dan. I don't know if you disagree, but just like the 401k usually is not most of the plans don't have exotic components to them. There usually are some mix of what Dan said: stocks and bonds, mutual funds. I think general market at your 401k, there's a general market aspect of it. If you have some cash that's liquid, you might be able to use self-directed IRAs, but that's really on a higher level. I'd say in the 401k, usually it just would be like general market, S&P 500. You want to be able, that's where you want to just ride the market on the long term. Dan, I don't know if you have something else to add.
Yeah, I mean, I think, if you don't want to take any risk at all, you leave that money in your cash in your 401k, it's not going to earn anything right now. There is no return for cash investment. So, I do think you have to be willing to take a little bit of risk, especially. And once again, it depends on the time frame in which you're looking to retire, right? If you're 1 year away, you take the money and you stash it in cash and you live off that principle. But if you're 30 years away, there are opportunities now to benefit your life in the future because the stock market's down 18-20%. Should you be aggressive? No, I wouldn't say be aggressive by any means, but if you have the time, there will be volatility. Yeah.
Maybe explain the idea of dollar cost averaging. I was trying to tell my kids that in a lot of ways, the fact that there's been a dip is good for young people because they can get in at a point that they didn't have access to for a little while. So as long as you have the ability to kind of contribute, there's some advantages to this idea.
Sure. So dollar cost averaging means whenever you buy an investment, whether it's a stock, it's a mutual fund, ETF, whatever, you're buying it at a point in time and you're buying it at a particular price. Now, since it's a point of time, the price changes constantly. And if you want to smooth out your risk, what you would do would be to buy, let's say, a share of stock over a longer period of time. So let's say you like Nike and you bought it on February 20th. and it was at $100 a share. I'm just making up numbers right now.
Mm-hmm.
And by March 15th, it's no longer $100 a share. It's $70 a share. If you bought amount, let's say you bought 100 shares on February 15th, you bought 100 shares on March 15th, the weighted average concept would be to say now your average purchase price per share of that Nike stock is $85 a share. It's not $100 a share that you initially bought. And as the market goes up and down, average costing just means you're buying it multiple times at multiple different prices, and you just weighted averaging that. I'll give you a good example. In my former job, we received bonuses January, February, and you had the option of putting in, all your 401k money for the year at the time that you received your bonus, if you received enough to do that. And, some people would do it because they said, well, I don't want a certain percentage of my biweekly paychecks to be taken out because it's, I have less money to spend. But what that really is if you put all your 401k money this year, let's say it's February 20th, you would have put it in at the very highs of the market, and you'd be looking at 25% declines. However, if you had opted to say, no, I want to smooth that out and I want to put it in, since it's biweekly, a little bit 26 times a year, you would be able to take advantage of kind of where the market is currently, and your average price would then be much lower than it would have been if you took it as a lump sum in February. So that's effectively the average cost.
Yeah, thank you.
Thanks, Dan. I'm going to roll through a couple questions. Keep them coming. Really good thoughts here. Hanan, I'm going to pass this one to you. How long do you estimate stocks such as Boeing will take to recover to their post-pandemic 737 levels? That's tough.
Yeah, so Boeing is an interesting conversation, and Dan alluded to that in his conversation. We're not sure how the travel industry is going to recover from this. We do know people are going to travel. Like I think everybody on this team, our seasoned travelers, Craig and Meg, have gone on overseas travels with colleges. I travel. We all travel a lot all the time, and we've gotten the itch. And I know you guys, as coaches, travel a lot, from games to recruiting and what have you. So we're going to travel. Let's put it that way. Travel is going to continue. Probably is going to be a lot of people feeling the same way as us with the itch to travel, with the need to travel. However, how is that going to elevate? And we got to remember who Boeing's clients are. Those are the airlines. With the airlines hurting so much, how quickly are the airlines going to be inclined to go and buy new planes? So what we're probably going to see is a delay in everything that's happening. And the Boeing's recovery is going to be very much dependent on the travel recovery, which is going to be very much dependent, which is going to affect the airline recovery, which then will affect the orders that are coming from Boeing. So I think Boeing is like on the bottom of the recovery tier that we're looking at coming out of this because of the hard hit that the airlines are happening. I think if I'm an airline executive and I just got if I got a bailout because we couldn't do anything, my initial goal would be to get as many planes up in the air, start getting the routes going and getting revenue on that. And the decision about spending a few $1 billion to get a new plane is probably the last thing on my balance sheet to happen. So I think it's really looking at these stocks is categorizing them, how they're going to be impacted from everybody going back into business. And I really want to encourage everybody, financial individuals, a lot of times like to put this veil of complexity in front of the financial markets. And if I said it once, I said it a million times, I know Craig I hear him laughing because I always say it. It's not that complicated. Yes, there's complicated mechanisms. Yes, there's extreme levels of portfolio management, and that's what Dan and I do every day, is those things. But at the base of it, when you look at our economy, it's pretty simple. And if you look at the questions like what's going to happen next, following the logic of what you think is going to happen is probably a really good starting point to look at how is the economy recover, how is it going to have an impact to that. Craig, I see you pointing at me.
Yeah,
you guys can't see it, but he was pointing at me.
Yeah. No, that was perfect, Hanan. And I think to give the example of in the travel space that Meg and Jim and I came from at Basketball Travelers and BTI, there after 9/11, everything stopped, but there was a huge pent up demand, and things came back, stronger than ever soon after that. So I completely agree with everything you said. We don't know what the timing, but in the sport space, especially with some of the advantages of taking your team on foreign tours and things like that, we've seen the example of that coming back, stronger than ever when things did open up.
Great, thanks, Hanan and Craig. Next question: would you say the best advice would be to exhaust all government programs, mortgage, credit cards, etc. first? I'm assuming maybe before you dip too deep into savings, etc.
Yes. I think unfortunately, the PPP program is done. The new money is already spoken for. I don't think I'm telling anybody something they don't know, but the economy has hit everybody. So when you think about it, everybody already applied. The majority of people have already applied to these programs. And there are so many in-queue applications that this new allocation of funds is only going to answer that demand. That being said, like I mentioned in the 401k, there are a lot of new developments and programs that are coming in online every day. And I would encourage everybody to seek out, whether it's a financial advisor, read for yourself, or somebody that you trust from a financial perspective, to walk you through those programs to see if there are any alternatives other than taking credit card debt. When you think about it, and I want to really touch really quickly about credit card debt. Credit card debt is dangerous. Your interest on your credit card debt is going to be 10, 15, sometimes 20% versus, like we were talking about earlier, 401k loan where it's going to be 3 or 4%. So depending on the expenses that you need to have, depending on your financial needs and the term of the money that you need to have it. Now, if you just need something to get you through a month, use the credit card, pay it back, great, it's all over. But if this is a long-term financial need that you need to support yourself, I would highly advise against going on the credit card debt and really look into the interest that you are going to be paying on this debt to not compound the problem of the financial issue that you have there.
Good, thanks, Hanan. Next question. My school has stopped contributing to our 403B contributions for the foreseeable future. I've been contributing a small amount of my own paycheck as well. Should I increase my own contributions now or leave it?
This is Dan. I would, if you have the cash available, I would increase it if possible. You're investing in the long term, and the market's down a pretty substantial amount. So, and if you have the cash, you should put as much as you possibly can in there, from a conservative perspective, though.
Yeah. Or the other aspect, so again, I think we're talking, it's hard to know because it depends where you are from your risk tolerance, right? So if you're in the conservative perspective, 100% put the money there. If you have extra money, like we were talking about earlier, there are opportunities now, and you're willing to take the risk, there are opportunities right now to be more aggressive, but it really depends on your investment profile and risk criteria like Dan was talking about. That's really, all investment decisions should come from your risk tolerance. Like Dan said, it's not worth investing in something if it keeps you up at night every night. Like you want to be, if you're putting the money, you know, the way I like to look at it, so if you're putting money something risky, it's like Vegas money. It's like you're taking this money and you're okay with all of it going to zero. That's the, you know, we need to look at investments in different areas, right? So you have your safe money, less safe money, and then you have your Vegas money. So make sure that you're okay knowing which bucket you're taking out of and putting in which investments from that perspective. And the 403B, you know, that allows you to take the tax advantages. So there's definitely something there to optimize and maximize depending on your risk profile.
Very good. Thank you. Another question coming in from Lynn. For those of us coaches who have retired and now paying RMDs, if I choose not to pay my RMD this year, am I required to pay double next year?
I'm not 100% no. I'm not a tax person, but I know I did read something that RMDs can be postponed and you won't have to pay double. But again, this is part of those government programs and the easing in the requirements that are there. Dan, I don't know if you have any other detail about the RMD.
Yeah, sorry, I don't. I can't add anything.
Yeah, I think
add anything.
I remember that there's something specific about that. So we can do more research and send you that information, or you know, I would advise if you have a financial advisor, reach out to them. If not, we can talk offline on that as well.
Great, thank you. Keep sending questions in. We've got about another 15 minutes. Next question: what are a few companies or industries that we should consider investing in while the market is down? We have to be a little bit sensitive on this question just since we are not investment advisors. But I think in a general sense, we can kind of at least address the industry side of things. So.
Yeah, I think, again, the way I like to look at it is common sense. What I like to say is we got a little bit of a glimpse of what 5 years into the future is going to happen. In 5 years, we would have, instead of 50 people streaming Netflix at the same time, we would have had 200 people streaming Netflix at the same time. Instead of having 1 or 2 devices on our Wi-Fi, now we have 15 devices on our Wi-Fi. And what we've realized is that our infrastructure on both power and internet and Internet of Things wasn't ready for the future. I just lost power last night. I live in the middle of Denver, in a very urban area that there's no reason that we should have had no power, and the generator should have been working in my building in this area. So looking at those aspects of what has this crisis showed us that we were lacking in. We were lacking in infrastructure. We were lacking in the healthcare area. We were lacking in the supply chain to our healthcare area. Finding those areas that we see that, you know, this crisis has brought to the forefront that we need improvement in, that's where the money's going to go into, because it has been kind of plain and simple for everybody to see. You know, some of us in the industry, you know, in the CoPeace and myself, we've been in the infrastructure world for years now, and we know this issue has been around, but the infrastructure investments have not moved up or forward because it's not been a prevalent issue. Unfortunately, if there's fires in California, they're not as affected, and you're living in New York, you're not as affected by that. You know, especially in addition to healthcare system, us that are pretty healthy or have good health, we don't see any issues in the supply chains for our healthcare providers. All these things that came out, those are great themes to start looking at investments and seeing investments in the areas where the market is.
Yeah, and I also think, you know, companies that are involved in with you know, the stay-at-home economy, and a lot of them are going to be growth companies, and a lot of them are very expensive. But you know, the trend is people, and the trend before COVID was people were staying at home more, and COVID has just accelerated that, you know, multiple times over. So, you know, you can start looking at those types of companies because the potential for growth there is just it's pretty significant.
Great. Thanks, Dan and Hanan. Next question. What's the difference between bonds and reserves, and which is better?
I'm not really sure what you refer to as reserves. So
probably cash.
Cash reserves?
Cash reserves. Let's answer it that way, Hanan, and then if there's more specification, we'll go from there. Yeah.
So bonds is an investment vehicle. Think about bonds as if you're a company, bonds is like you taking a mortgage from the bank. You're going and taking debt from the bank and putting collateral or what have you on as your house or your earnings, and then the bank's giving you that money. A bond is basically a company coming in and taking a loan from the market, and you're their bank. So basically, the market is their bank, and they're saying, here's my credit score, right? That's the credit rating that they have. Here's my earnings. Here's maybe some collateral that I can put as a company. I want to take a loan, and I'm going to pay you interest for it, just like you're paying interest for your mortgage. So that's how you want to look at a bond. A bond investment is also, like Dan said, is the highest level of, it's the first people that get paid back. Basically, if there's any issues with the company, it's the first people that get paid back. So that's, from a tranche perspective, is the kind of the safest investment. Cash reserves is the cash reserves that you have, and they're not an investment. You want to keep some level of cash liquid in order to cover your rent, your mortgage, your car payment, your grocery bills. Bonds are usually not bought and sold. Bonds a lot of times are bought and held to maturity. Bonds are similar to what CDs would be, in my mind. It's not something you want to actively trade unless you're a bond trader or in a bond fund. But if you're looking just investing in a bond, that is more of a 1 year. That bond will have a term that it will mature, and then you'll get your interest payments, whether through it or later through it. So it's just a different level of investment tranche. That's kind of the difference between bonds and cash reserves, to answer that.
And right now, cash reserves probably right now are not earning you much, if anything, right now.
And neither, and bonds are not earning that much either. Yeah.
Very good. Thank you. Next question. If you were in your 30s and your investments don't keep you up at night, would you decide to shift your investment strategy to the Vegas money you were just talking about in order to capitalize on this situation? It's a great question.
So I wouldn't shift it. I would allocate. There are opportunities out there, but there's nothing to shift, because you should allocate the Vegas money is the money that you're willing to, like, the Vegas money is the top of the tranche. So let's say, yes, there's more opportunities, but you should be okay with that money going to zero on your long-term plan. So maybe, you take advantage of it, but the amount of that money is not specifically detailed by the market situation, because there's always opportunities to use Vegas money, right? If you invested in Netflix when it was early on, or Google when they were early on, right, when it was the heyday of internet, it doesn't matter if the market's up or down. The Vegas money is really to invest in illiquid companies that have the opportunity to provide not market correlated return and very large appreciation, but also have that risk of actually going to zero. And those are usually the startups, the risky stocks. So I wouldn't shift your investment strategy. I would allocate the proportionate amount of money that you feel comfortable in your 30s, which is probably higher than if you were in your 60s. But I would not ignore the, long and steady wins the race. That is a tried and true. So, you want to have a combination of the two. Yes, you early on in your career, you want to probably allocate more to those big opportunities because the long and steady has more time to grow up, but you don't want to ignore it and shift it completely, because also compounded interest and compounding returns are an area that, we all have this. I'm sure you've seen the articles and stock. If you put money in Apple in 1990 and just kept the money there, right, 30 years later, you're a millionaire just by putting $10,000 in that. So you don't want to miss out on those opportunities either, of just the long-term horizon of the appreciation because you're so young in it. So you really want to create a balanced strategy, but not get too aggressive with either one, depending on where you are. And I know that answer was all over the place, but it really is hard to give investment advice without targeted risk profile.
Well, we'll share our apples of the future in another series. But I think Dan's 110 suggestion still is very effective for that question.
You know, I could add something to this. I think you know, depends on what you say Vegas money is, right? And this might sound a little backwards, but pre-COVID, the types of investments you might think as Vegas money investments might be things that are significantly riskier than what you could invest today in what's considered Vegas money. I'll give you for example. Let's say you're trying to generate a 30% return, and a friend comes to you and say, okay, I have a restaurant, and gives you a business plan. The person's a great chef, great restaurateur, they have a great location. You say, okay, I think I could generate 30% return. Even before COVID, and we're not even talking about the effects on restaurants, you know, restaurants themselves had a high risk, and their risk is even greater today. But in order to generate 30% return, maybe that's where you would put your money. Because the market's down 18, 20%, if you want to generate a 30% return, you might be able to put it in certain names within the stock market, which has a lot of one-off restaurant does, and still generate those types of returns. So even the particular investments that you're looking at may have changed and actually may have become a little bit more conservative now than it would have been pre-COVID market.
Mm-hmm. Very good. Thanks, Dan. Dan, I think this is a good follow-up question for you regarding kind of portfolio management. How can I compare the difference in returns between traditional and alternative investments, and where would I find that information?
Sure. Traditional returns are pretty much out there anywhere. Most of the major banks issue different return profiles on different asset classes. Alternative investments, it's such a broad term because it's a catch-all for anything that's not equity and it's not fixed income. So it really depends on the particular alternative investment that you're looking for. Many investment banks will produce this information, but a lot of times you have to be a customer of that investment bank to get it. So I don't have a great answer for that, just because alternative investments is such a broad term, and depending on what it is, where you look for it will change.
Very good. Does anyone else have any other questions they'd like to throw in the Q&A? We've got a couple more minutes. Happy to answer anything you've got. Otherwise, we can wrap it up.
I did want to say something. Well,
go ahead.
Not that I didn't talk enough, but I did want to say something. I think on the brighter side, I think as an athlete and all of us being involved in NCAA athletics in one way or the other, they're going to come back, and they're going to come back stronger than ever. I think only to show us one of the most watched TV series right now is about the Chicago Bulls playing in 1997. People are clamoring for sports. People are hungry to see sports. NCAA athletics have always been something that people are passionate about. That's not going to go. And I think those sports, now that we have had a time without them and seen the effects that the lack of sports has on our society and felt it, anywhere from the Ivy League swimming championship being canceled, which was a personal thing for me, to the Olympics getting canceled, to the NCAA tournament where we were supposed to be having this conversation. You know, this was a big effect, and we're all feeling it. And so I think there's going to be a lot of support and a lot of backing to NCAA basketball and all the other sports. So I actually feel very encouraged on the direction and kind of the proof of concept that like how integral these sports are a part of our life. So I just wanted to mention that as a positive thing.
No, that's a great closing, Hanan. I appreciate that, because we always try to end all of our meetings on a positive note. And so I think that's great perspective. I'm going to turn it back over to Craig to kind of wrap us up. And as we mentioned earlier, if you do have additional questions that perhaps didn't get asked or answered, please feel free to contact us directly, and we will definitely follow up with all of you. So.
Yeah, thank you, Meg, and thanks everybody. The Last Dance, the ratings were humongous on that, because I think, like as Hanan was alluded to, everybody is starved for some sports content. We, you know, at CoPeace, the idea was to kind of create a like a Berkshire Hathaway. I'm a Berkshire Hathaway shareholder, and I've been listening to Warren Buffett for a long time, and I've been to the Woodstock of Capitalism in Omaha and listening to him, and we want to create something that is here that is of service to the coaching community, because we come from that community. We know that there is potential in sport. I wanted to thank our team and thank you all for coming. I think we had Jordan and Pippen here of the financial world. You guys can decide who's which, but it was really something that we look forward to on our side, and look forward to continuing actually with the NABC and some other sport communities. So thank you very much for being here. We look forward to connecting again in the future, and have a great day.